Is silver a good or bad investment in 2026? Silver is sitting near $72 per ounce today, February 18th, 2026. That number is not what most people expected 12 months ago. 1 year ago, silver was trading around $30. That is a move of more than 140% in under 12 months. And yet, 2 weeks ago, silver briefly touched levels close to $120 per ounce before collapsing more than 30% in a single trading session. The biggest one-day decline for silver futures since 1980. So the question is not whether silver has been a good investment. The question is what kind of asset silver actually is, and whether the structural conditions that drove this historic rally are still intact. Is this a bull market with normal volatility? Or did silver just deliver its best story and then begin a slow structural unwind? That is what we are going to work through today. If you find this kind of analysis useful, subscribe to the channel and hit the bell icon so you never miss these deep dives. And if this video adds clarity to your thinking, A-like helps us reach more serious investors like you. Let us start with the data. Gold is currently trading near $4,807 per ounce, down roughly 3% today and down significantly from its all-time high of approximately $5,595, which it hit in late January 2026. Silver, as noted, is near $72 after peaking close to $120. The gold to silver ratio has widened back to approximately 67 to 1. At the peak of the silver rally, that ratio briefly compressed toward 45 to 1. The rapid re-widening of that ratio tells you something important about how differently the two metals behave when institutional and retail positioning reverses simultaneously. Silver, because more than 50% of its demand is tied to industrial applications, carries a dual exposure that gold does not. Gold is primarily a monetary asset. Silver is both a monetary asset and an industrial input. When risk sentiment shifts, silver gets hit from both directions at once. Investors selling hits at the same time that industrial demand forecasts are being revised downward. That is exactly what the data from the past 2 weeks is showing. Now let us understand what drove the rally in the first place. Between the inauguration in early 2025 and the end of January 2026, gold roughly doubled. Silver rose nearly fourfold. 3 structural forces were working simultaneously. First, dollar weakness. As the administration applied sustained pressure on Federal Reserve independence and pursued unconventional trade and fiscal policies, confidence in dollar stability eroded. A weaker dollar is historically correlated with stronger precious metals prices, because gold and silver are priced in dollars and serve as alternative stores of value when the dollar's purchasing power is questioned. Second, real yield compression. With inflation remaining elevated and the market pricing in the likelihood of multiple Fed rate cuts through 2026, real yields, the return on Treasury bonds after adjusting for inflation, were declining. When real yields fall, the opportunity cost of holding gold and silver drops sharply. You're giving up less by not owning a yielding asset. That makes non-yielding real assets like silver structurally more attractive. Third, central bank accumulation. The People's Bank of China extended its gold purchases for a 15th consecutive month in January 2026. Global central bank demand reached 863 tons in 2025 and is expected to remain above 850 tons in 2026. That is not a tactical trade. That is a structural shift in reserve asset allocation that provides a persistent floor under both gold and the broader precious metals complex. Silver benefits from that floor indirectly because capital flows into precious metals broadly when central bank credibility is being questioned globally. Now here is what changed 2 weeks ago. Markets began rapidly repricing the timeline for Fed easing. Strong payrolls data and inflation data that came in hotter than expected forced traders to revise their rate cut assumptions. Where the market was previously pricing in 3 cuts for 2026, that expectation began collapsing toward 2 cuts. And the probability of a March cut fell to roughly 21% according to CME Group data. Simultaneously, the US dollar firmed. A stronger dollar mechanically pressures precious metals prices. And with the Shanghai Gold Exchange and Shanghai Futures Exchange closed for Lunar New Year through February 23rd, the critical arbitrage support that typically comes from Asian physical demand was absent. The result was a liquidity vacuum. Paper selling accelerated with no structural bid from Eastern physical buyers to absorb it. Silver, with its larger industrial component and thinner physical market, absorbed disproportionate damage. The 30+% decline from its all-time high in less than 2 weeks is violent by any standard. But it is important to separate violent price action from a change in structural fundamentals. Let us go deeper on the structural picture. Silver has now recorded 6 consecutive years of market deficits. That means physical demand has exceeded newly mined supply for 6 straight years. Industrial demand for silver is being driven by the global build-out of solar energy infrastructure, electric vehicles, medical devices, and advanced electronics. The Silver Institute has estimated that solar panel manufacturing alone will require increasingly large volumes of silver throughout this decade. Supply cannot be rapidly expanded. Mine development cycles are long, capital-intensive, and politically complex. Recycled silver supply increased only 2 to 3% in 2025, despite sharply higher prices. That supply inelasticity matters over a 5-year and 10-year horizon. Compare that to bond markets. The U.S. national debt is approaching $56 trillion. The interest cost of that debt is now projected to exceed GDP growth, creating what budget analysts are describing as a potential debt spiral. In that environment, the real return on holding long-duration treasuries is deeply uncertain. If inflation persists at 3 to 4% while nominal yields sit near 4.5%, the real yield is barely positive. And if debt monetization becomes a policy tool to manage that fiscal burden, real yields could turn negative again. That is precisely the environment in which silver and gold historically outperform on a capital preservation basis, even if they lag equities in nominal terms during periods of strong economic growth. This is the optionality argument for silver. You are not buying silver to beat the S&P 500 in a bull market. You are allocating to silver as structural insurance against monetary debasement, fiscal instability, and geopolitical disruption, all three of which are simultaneously elevated right now. Let us now walk through 3 scenarios, because intellectually honest analysis does not give you one outcome. It gives you a probability-weighted range of outcomes. In the bullish scenario, the current pullback is exactly what UBS strategists described this week. Normal volatility within a continuing structural uptrend, not the end of the bull market. The Shanghai Gold Exchange reopens on February 24th, and physical arbitrage demand from Asia restarts. The Fed resumes its easing cycle by mid-year as economic data softens. Real yields decline again. Dollar strength fades. Under this scenario, silver likely recaptures the $85 to $95 range within months, and the long-run physical deficit continues to compress available supply. The probability weight on this scenario depends on whether the recent dollar strength and jobs data represent a durable trend shift or a temporary repricing. Currently, most of the structural factors that drove this rally, deficit spending, central bank accumulation, dollar credibility pressure, industrial demand, remain intact. That keeps this scenario credible, not guaranteed. In the bearish scenario, the sell-off is not a healthy correction. It is the market beginning to reprice silver away from its parabolic retail-driven narrative. Goldman Sachs analysts flagged supply constraints in the London physical market as a risk and warned that at prices near $100 and above, industrial end users begin substituting or reducing silver consumption. That demand destruction at the margin matters. If the Fed holds rates higher for longer, with the market currently pricing 78.9% probability of no cut in March, real yields stabilize at current levels. If geopolitical tensions ease around U.S.-Iran negotiations and the Ukraine-Russia situation, the risk premium embedded in precious metals partially unwinds. Under this scenario, silver consolidates in the $60 to $75 range for an extended period, perhaps 6 to 12 months, before finding a new equilibrium. This is not a collapse scenario. It is a mean reversion scenario after a parabolic move. In the neutral scenario, which may be the most probable over the near term, silver trades with high intraday volatility in a wide band between approximately $65 and $85. The Shanghai reopening on February 24th provides a short-term bid. FOMC minutes released this week provides a policy signal. U.S. GDP data and PMI releases on February 20th shape growth expectations. Each data point creates a whipsaw. This environment rewards patience and punishes reactive positioning. In a consolidation phase with elevated volatility, the investor who bought silver at $32 in early 2025 is still sitting on a 125+% gain, even with silver near $72 today. The investor who bought silver near $115 in late January is down more than 37%. Entry point matters enormously in any asset class, but particularly in silver, where intraday swings of 5 to 8% are now routine. There's one additional layer worth addressing. Silver has been called GameStop in 2026 by some market observers, referencing the flash of retail investor enthusiasm that accompanied the parabolic move. That comparison carries a warning. When retail momentum becomes a primary driver of an asset's price, the resulting move tends to overshoot intrinsic value on the way up and undershoot on the way down. The structural thesis, physical deficits, industrial demand growth, monetary debasement, is real. But the speed of the move from $30 to near $120 compressed years of structural repricing into months. That kind of compression typically requires a digestion phase, where fundamentals and price realign. The current pullback may be precisely that digestion process. Structural investors who understand the difference between price and value will approach this phase differently than momentum traders who are responding to yesterday's chart. So where does this leave the disciplined investor thinking about silver in 2026? Silver is neither simply good nor simply bad as an investment. It is a structurally supported real asset in a macro environment defined by fiscal excess, elevated inflation, weakening dollar credibility, and persistent geopolitical uncertainty. All conditions that historically favor real asset allocation. At the same time, it is an asset with concentrated industrial exposure, thin physical markets relative to paper markets, and a demonstrated capacity for violent corrections following parabolic moves. The honest allocation logic is this. If you are treating silver as a core capital preservation position within a diversified portfolio, alongside gold, real assets, and some equity exposure, then the structural case remains intact. If you are treating silver as a vehicle for rapid return generation with high leverage, the price action of the last 2 weeks is a reminder of the asymmetric downside that accompanies that strategy. The physical silver market will not resolve its supply deficit in 6 months. Central banks will not reverse their reserve asset accumulation strategy in response to one data release. The U.S. fiscal trajectory will not correct itself quickly. Those structural realities provide a durable foundation, even when paper markets are pricing in short-term policy shifts aggressively. The question is not whether silver will eventually reflect those fundamentals. The question is your time horizon and your capacity to hold through volatility of 20 to 30% in either direction without being forced to sell at the wrong moment. That is the discipline that separates structural investors from market participants who end up funding someone else's positioning. If you found this analysis useful, please leave your thoughts in the comments. Are you accumulating silver at current levels or waiting for a clearer signal from the Fed or the Shanghai reopening? Let us hear your thinking. Subscribe to the channel and hit the bell icon for ongoing analysis as this situation develops. And if this added value to your decision-making process, a like helps us keep producing this kind of content for serious investors who want more than headlines.